In a study of the impact of war on stock markets in frontier countries, Caravan Capital Management, a fund that invests in frontier markets for wealthy individuals, found that many conflict countries experience intense post-war rallies. From January 2000 through October 2010, as per Caravan's survey, there were at least 10 occurrences of overt military conflict in countries with stock markets, primarily within the frontier, pre-emerging markets. The countries assessed in this study were Colombia, Cote d'Ivoire, Georgia, Iraq, Lebanon, Nepal, Nigeria, Palestine, Pakistan, and Sri Lanka. In order to assess the impact of war on local equity markets, each country's conflict was broken down into a pre-conflict phase, conflict phase, and a post-conflict phase. The study found, post-war rallies may represent alpha generation opportunities for active managers, says Benjamin Griffith, an analyst with Caravan. Caravan carried out a study to determine if the post-conflict rallies experienced in most ex-conflict countries outweigh the downturns experienced once hostilities break out. It turned out that the average impact of the period of hostilities and post-hostilities was more or less flat, so there may be a net benefit to investing in conflict countries once their wars have commenced if stock prices have fallen dramatically, even if a finite end is not yet in sight. For instance, you would have made out quite well to get into Sri Lanka in January to March of 2008, relative to global indices, even though that marked the real beginning of the intensely destructive period, because the post-war rally outweighed the conflict period declines, as much of the cost of the pre-conflict phase of war is typically characterized by increasing tensions between rival factions and were visible in car bombings in Iraq, and Russian troop movements in Abkhazia prior to the war with Georgia. This phase can actually be more destructive to stock market valuations than the conflict period itself, says Griffith. In some cases there was a rapid deterioration of market confidence, and these countries saw much larger declines than the average 29.2%.